Hi, everybody. Dan Sheridan here today, and I'm going to talk a little bit about calendars and Greeks. I'm going to start with a single calendar, something that I've been doing for years, and I'll share it with you as an example so we can talk about the Greeks. But let's say I go here, I'm going to go out, usually on Thursdays, I'll do a 15-day calendar. There'll be like today, Thursday, 2 weeks from tomorrow. So I'm going to go out 15 days on my short. So if you look here, I'll open this 15 days here, and I'm going to look for, generally what I'll do is I may open it a little bit under the market. If we're a little bit under where the price is trading at, like we're at about 67.63 in SPX. So I might start it a little bit under the market, 67.40, and I'll get to that in a second. So I'm going to sell the put 67.40, and that's about 25 points under the current price of 67.65. And then I'm going to come up. So I sell 15 days out. I usually will do this on Thursdays in the afternoon. Then I'm going to go about 19 days out. So there'll be 4 days difference between the long and the short. I'm going to buy the same strike. That's what a calendar is. A mixed month spread where you're buying further out, expiration, and selling closer in. So here I'm buying the put. So I'm buying a 19 days out 67.40 put, a little bit under the market. The delta is actually like 43. And I'm selling a 67.40 put. Now, if I view chart, now you got an idea here of what it looks like. Again, I can, using this range button here, I can move it a little bit so you can see here. And let's start out by discussing some of the Greeks of the trade. So if you look at this trade, you can see the deltas are 0.1, right? 0.1. So that's pretty close to neutral. And so the reason that I place the strikes a little bit under the market, maybe 20 points or so under the market, is because I could get a little extra room to the downside. Mostly we've been uptrending this year. So I'd like to have maybe a little bit more room down. Generally, we can, on the downside, we can go down faster than we go up. So it kind of gives me a little more room to my break even on the downside, but it keeps my deltas relatively close to zero. As you can see, I'm still long delta, 0.2, even though I'm placing the strike 67.40, right, underneath the current price of 67.55, right? In this case, it's 15 points under the market. But I'm just getting a head start to the downside without having to commit the deltas. So this would be the type of trade that I would do. The cost of this would be about $725. The theoretical theta would be $40. So you say, well, wait a second. 40 divided by 700, Dan, is about 5.7. Are you telling me I'm going to make about 5.7 potential profit each day on this thing? Well, in the world of theoretical, yes, but the world of theoretical and actual Greeks can be a little bit different, right? Different factors can slow or increase the theta. I like this type of trade because Thursday, I was a market maker for many years in the pits. And, on Thursdays, based on demand and supply, and Friday, you have more sellers of options, people trying to get the theta for the weekend. And again, the market makers, you know, we would just lower we don't know anything. I mean, in terms of where the market's going, it just is there's more sellers, we would lower the volatility. And then when Monday, when all the sellers are maybe not there, as far as the sellers of options, we put the volatility back up. That's why you see a lot of times on Monday morning, the volatility is up. So anyways, this is just a 15-day calendar. Let me just say something else. Dan, do you normally do Here's a single calendar. Do you do double calendars? I like double calendars a lot on shorter term durations. Once we start getting 15, 20, 25 days out, as far as doing a calendar trade, selling an option 15, 20, 25 days out, I generally, not that you have to start with a single because your gamma is so low, it's near zero. I don't need it's more important to me with double calendars. When you start getting close to expiration, I want more room. I need that room. I don't, your deltas change very little here if we go up or down 1%. And if you look here, if I click this, uh, you see up here at P&L. So right now I just have the P&L graph and today. So I can move as we go up or down, you can see how the P&L will change. And obviously today, if we go too far up or too far down, especially towards the break evens where the expiration graph crosses zero today, you'll start losing some money. But the other thing is you have a lot of room. If you look at these break evens, our short strike we're at 67.40 right now. So SPX must be going down while I'm doing this trade. But right now we're at the money. Well, if you look at the break evens on the single calendar, again, because we're 15 days out, I've got over 100 points, 115 points to the downside, about 130 points to the upside. So you have a lot of room, right? VIX right now is around 19. So the higher the volatility in the market as the VIX goes up, when you're doing a calendar, you have wider break evens. That's what it does. But when the volatility goes up, 19 VIX for 2025 is in the upper end of the range. If you exclude April high volatilities for a week or so, the range in VIX has been anywhere from 14, 15 on the low to 21, 22 on the upside. So 19 is kind of getting up there a little bit over the middle. So you're concerned if the volatility goes down. But from a price movement, you've got a lot of room. I'm more interested in using double calendars when I start getting 10 days, 9 days, 8 days, 7 days, because price risk really can get exasperating at that point against your trades. That's the most important thing. So if you look here, let's just go over a few things. Let's just start with one factor. Let's look at P&L and delta. And especially as you can see, with the deltas were pretty neutral, 0.4. But as the deltas go up, right, your deltas will get short on the upside, and then they'll get longer on the downside. And you can see the P&L will go from the middle of the graph, which is fine, to if we go to either extreme, your deltas are going to get shorter on the upside and you'll start losing some money. And on the downside, you'll be getting longer deltas and your P&L will get negative. Well, what if we take that delta and go over time, right? Like, so if we went down on this calendar, you could see, towards this break-even area where it gets red, P&L, you could see them down $128. Well, what if we are looking at delta, but let's go here, we're 15 days out when we start. Let's go to about 12 days. So here we 12 days out. I just moved the slider bar. It's very easy. Now, as I look at the deltas, you see more green. So if we go down towards the break even, my P&L was down money before. Now it's like break even. So why, with a calendar, when I just went from 15, I just took 3 days into the future and it eliminated, it showed me a lot more green profitable area, but my P&L down here near this expiration break even, where the expiration graph crosses the zero line, is fine now because this is a positive theta trade. So as more days pass, I can handle a move better than I can day one, right? Here's day one right at the beginning. If we go down, I'm down $140 and I'm delta 1.8. If we're 3 days into the trade from 15 to 12, we get down in this area, I'm longer deltas, 2.26, but my P&L is fine. I've accumulated some theta. So that's seeing how delta works. Let's go back in here and look at some of the other Greeks. How about theta? And again, you could hit a couple Greeks along with the P&L. It gets a little busy, but you can do that, and that's very helpful. But let me just focus on one. I'm looking at the P&L, but I just want to look at theta, right? So if we look at theta when we start out the trade, our theta is $42 a day. Again, this is a short-term trade. And you can see that theta number, positive 42. So they're saying, yeah, just one day goes off the clock. Theoretical theta on this trade of $710 is 42 bucks. Well, that theta, as we start moving away from the middle again towards these expiration break evens, your theta here on day one goes to 31. It starts going down. And on the way down, you can see the theta goes from here 42 down to 32, right? And in both cases, the P&L is negative, right? Again, you've had no theta accumulation. If we're down here, you start getting down here, your P&L is negative and your theta goes down. But what if we again go through, take it this a 15-day trade, go 4 days into the trade, right? Or 5 days into the trade. Here's 10 days left. November 11th, Tuesday, November 11th, we moved it to. Now, if we start looking at the theta and we start going towards down here, you see our theta is 44, but again, the P&L is positive on these calendars. So what's the principle? Early on in a big trade, if you go to the break-even points on a calendar, you can lose some money. 2-3 days into a trade, if you go to the break-evens, you can handle that move. Now, the reality, just one point of reality here, we can go reality, right? If you look at when I put this calendar on, and again, we're on a busy day, so the SPX is moving a bit. But if you look at where it's 67.30, okay, here we're at 67.40. But if you look at from at the money and say, our break evens are like 100 points down. Our short strike is 67.40. Our break even down here, is going to be 66.20. We have over 100 points. Well, anything can happen, but if you look at, from a standard deviation, expected move probabilities, the probabilities, I'm just looking at the market now, the probability of moving 100 points, we'd have that in about 5 days. But in one day, like tomorrow's, we could go 90 points possibility. In other words, it gives you a lot of room, especially in a high vol environment. So anyways, those are just some things I'm looking at. I was just talking about calendars today in the market, and we'll come back next time and look at some Greeks and some other strategies like the double calendar. Thank you.